Hello, and welcome to another edition of Analyst Insights. On this program, we are discussing all things markets, economics, and business, especially as all these things are affecting the capital markets, our local capital markets. And today, as usual, I'm joined by my colleague, Rufaro. Welcome to Analyst Insights, Rufaro.
Thank you for having me, Ranga.
Good. There was so much to discuss as we were preparing for this show. And I realized that there's a lot that is covered in today's papers. And when you just glean onto the ZFN exec summary, quite a lot of activity in terms of things that we can discuss. Maybe the starting point will be on fuel. The prices keep on going up in US dollar terms. And what does it mean? What should we brace for the economy and for the household and everyone around? What do you see as the impact of all these things happening?
So Zimbabwe imports all its petrol and diesel. And in this regard, we are price takers. We are not able to negotiate prices. The prices based on the international markets for Brent crude and West Texas Intermediate, and these are global commodities markets. And at the moment, there is a war in Europe that has affected one of the major producers, and therefore we are seeing very high fuel prices. So on the global stage, so these high prices on the global stage then trickle down to us here in Zimbabwe, and the import cost of fuel therefore goes up, and that's what we're starting to experience at the pump. So you know, it because of the way our fuel sector is regulated, these come to the market via announcement by ZERA. But I think that this is just the beginning. You know, the war in Europe is going to affect the prices of many commodities. It already has, and I think that it's just the beginning. Things will get worse going forward, and we're going to see the prices of everything on our import, or most things on our import bill, whether it's cooking oil or grain, going up.
So what do we need to do in the short term, or maybe you can also try and venture into the long term, given that fuel is a big part of costs for most businesses, and obviously when prices are going up, there is a cost escalation across the board. What do we need to do in the interim, and what could be the long term strategy we should adopt?
So in the long term, I think what's interesting is that if you look at the South African economy, for example, you know, it's about 40 to 50 times bigger than ours, depending on which numbers you use. And they have a plant operated by Sasol in that country that converts coal to diesel, and that basically supplies that market with more than 30% of their diesel supply.
Okay.
And Zimbabwe is well endowed with quite a lot of coal. We have some of the highest reserves in the world in Hwange and in Sengwa. And I think that if we had an environment amenable to significant amounts of foreign investment, in the long term, one of the solutions for us would be to build such a plant in our country and not only meet our entire diesel demand, but then become a net exporter of diesel. So if we experience shocks in the price of oil on the global markets and the price of fuel goes up, we would actually, instead of suffering a higher import bill and higher fuel costs, we would actually benefit from higher exports. So I think, you know, the fact that we've got these massive reserves at Hwange and in Sengwa, it's not news. It's been known for many years, but we haven't seen the requisite investments to exploit these reserves because we have an exchange control and regulatory framework that is not attractive to most foreign investors. So I think that those are some of the things that we ought to look at in the longer term. In the short term, there's really not much we can do as far as the import bill is concerned. But I think we export quite a lot of commodities that are trading at record highs or near record highs. And I think that with relatively modest investments, we can increase production at all our mines that are exporting these commodities in the short term, in the next 6 to 12 months, I think that these high prices are going to prevail in the short term. And I think there's an opportunity for us as a country to increase production on our existing mines in the short term.
And talking about that, one of the other major news items is on gold, where output is said to have jumped by 86.3%. This is coming from Fidelity Printers. And I think some of the issues that you are mentioning there, they're talking about new investments, expansions, and also incentives into the gold sector. What do you make of the output that we've achieved in the last five months? And do you think maybe they are following onto the strategy you're talking about, that maybe now when the commodity prices are up, let's ramp up production, or maybe something different?
So I find it difficult I don't think that the reason why deliveries are up 86% is a function of production on the ground being up 86%. My best guess would be that what's actually going on is that the production hasn't changed materially, but what's changed is the incentives for the small scale producers who produce most of the gold in our country, the incentives for them to actually deliver to Fidelity. So when the incentive structure makes sense for the small scale grower, they will deliver more of their production to Fidelity. When the incentive structure doesn't make sense, the perverse incentive is for them to smuggle the gold out instead of delivering it to Fidelity. So where I think we have to give credit to Fidelity and the government incentive structure is that it has created this positive outcome of significantly higher deliveries through formal channels. So the question, as always in our inflationary environment, is will those incentives continue to be relevant? Will we continue to be a good choice for delivery to the small scale growers? Because the moment it stops making sense for them to deliver to Fidelity, they won't. And those deliveries will come off, notwithstanding what's happening on the ground with production.
I think one area that maybe has been an issue has been the exchange rate at which gold producers are getting a portion of their the surrender requirements at. And I think in the recent, the past 2 weeks actually, we have seen a narrowing of gap to a point where the interbank and the auction rate are pretty much at par. And of course, they remain very low compared to where the power market rate, because these ones are around at 325 and the power market is anyway around 500 to 525. What do you want to see happening? To what extent is this positive and supportive of any economic development in what you are seeing in the gold and other sectors of the economy?
So firstly, I think it's commendable that there has been this significant movement in the interbank and auction rates over the last few weeks. I think where the rate was stuck in the official markets at circa 185, 190, those markets were becoming irrelevant. And we were getting to a point where we were punishing exporters to the extent that they would not be able to sustain production. So certainly, from an exporter's point of view, 325 is much, much better than 180. But it still comes short of where we need to be, because what the power market is telling us is that, willing buyers and willing sellers are trading at a 50% premium, more than 50% premium to the auction and interbank rates. And as we saw month-to-month inflation for May at 21%, and the trend is, the outlook is negative. So if a few months from now, if we are not aggressive in terms of adjusting the auction interbank rates, we'll again find ourselves at a place where exporters are struggling to meet their operating expenses, and they are not going to increase production, which is what they should be doing in this environment of very high and attractive commodity prices. So I think, we've always advocated on this show that to the extent that we are talking about markets with willing buyers and willing sellers, let's be faithful to that principle and let the market be free floating. And if we need to sustain that policy. It's not good enough for us to just get to a place where it's willing buy, willing seller for a few weeks, then revert to a control rate. We need to actually be very consistent so that exporters and their investors can plan, and then we see a significant increase in investment and production in the export sector. We are not going to see that happen as long as the current exchange control regime is in place.
Interesting. Let's go to the markets. One of the things that I've always wondered, ever since the multi-currency was actually restored, was the question around what are companies doing with the US dollar cash holdings or cash receipts. And the last 2 weeks we've seen some of the listed companies actually declaring dividend, which is partly in Zim dollar and also partly in US dollar. And I thought it was commendable, given that maybe there are not too many exciting investment for them to reinvest in. And obviously the return on investments may not be that good, and it makes sense to give the money out to the shareholders. But what other kind of signals are you seeing from this development? Do you think it's positive? Do you think how long is it sustainable? Is it the best thing for these companies to do, to be giving this money out to the shareholders? And what does it say in terms of the makeup of transactions in the economy, Zim dollar versus US dollar?
So there's a lot to digest there. So the first thing is that these companies are paying dividends in US dollars. This is actually, since the return of the Zim dollar, this is actually unprecedented. All the dividends they were paying were in Zim dollars. So to the extent that they are paying in US dollars, it's a acknowledgement that a significant portion of their revenues are in US dollars, and therefore a significant portion of their earnings are in US dollars. And if you look at Delta's numbers, for example, I think of Delta as a proxy for aggregate demand. If people and disposable income in the economy. So if Delta's volumes are going up, it's a reflection of aggregate demand in the economy going up, and vice versa. And if Delta is saying, look, we're getting 60% of our revenue in US dollars, to me, that's a good proxy for the extent to which our economy has dollarized. So there's this informal sector that we all talk about where money changes hands only in US dollars. And we don't have good data in terms of how big this informal economy is, how much money is outside the formal banking sector. But one of the things that we know happens is that this informal sector consumes Delta products, and they are likely to pay for these products in US dollars because they trade in US dollars. So I think it's a good data point to guess the size of our informal sector. I think it's 60%. I think it has grown. And it's also a reflection of the frustration in terms of growing the formal sector. I think where we're seeing growth, and it's difficult to measure, is in the formal sector in US dollars. So it's not only Delta. If you look at they're paying a significant portion of their dividend as well in US dollars because they're a significant portion of their revenue and therefore earnings are in US dollars. So to me, what it speaks to is a trend as we see high inflation and the Zim dollar being unattractive. We're seeing more and more transactions happen outside formal banking, outside the formal sector, in the informal sector, and hard cash.
I think maybe the last point, maybe in a minute, I just want to get your reaction. It's a major acquisition transaction that we've seen with on Lafayette. We know for a long time it has been on play because the major shareholder there had indicated that they were looking to invest out of local Lafayette outfit. What's your reaction to the recent announcement? And if there's any significance to the capital markets, or maybe just a comment, something to note?
Look, I think it's always, on the one hand, it's always sad to see a foreign investor exit our market. I think we've seen a lot of that happening over the last 18 to 24 months, especially on our local base. The net movement has basically been in foreigners exiting the market. But I think the positive, because our market is so challenging from a regulatory standpoint in terms of policy changes, I think that a business like Lafarge is best suited to be owned and run by a local because they understand the environment better and how to navigate better. So I think perhaps in terms of the prospects of the business itself, growing market share, increasing production, being more efficient, I think that this is much more likely to happen in the hands of a local investor than a global multinational.
Thanks so much, Rufaro, and thanks so much, our viewers, for watching this episode. We want to hear from you, so your comments on our social media platforms. Also remember to like our Facebook page, that is ZFN Capital, and to subscribe also on our YouTube channel, which is ZFN Capital. And let us know whether you agree, disagree, or things that you think maybe could help move our markets forward. Otherwise, thanks for watching, and bye-bye for now.